Good evening, students. Welcome all of you all to our today's session on one of the most important and my favorite topics, PGBP. So now we are into the details of PGBP, and as you all remember, we have started discussing the minute fine prints of the law from our module itself. So now we will also try to engage into the technical language, the technical deliberation of the topic, so that we are also well versed with the legal usage and the minute details. So with this, let me start. Very good evening, Tej, Soumya, Shalini, Pragya, Ishan. Ishan has a question. Sir, I have a doubt that if a property is vacated and then occupied by the owner, then we do not have to calculate A or B. So, see, understand this. When you are property, assuming you are not again putting it up for letting out. So where you are not putting up the property for let out and the existing tenant has vacated, and then you are occupying it for your own self, it becomes a self-occupied property. Now, once it is a self-occupied property, the first test that you have to see is whether you have more than two self-occupied properties. If you have up to two self-occupied properties, then the GAV would be nil as per section 23 bracket 2. But if it is more than two self-occupied properties, then there will be a challenge, because in that case, more than two self-occupied properties, you may end up paying tax by deeming the GAV as the ER for any of the properties over and above the two allowed properties. Fine. Okay. So let us go to this. We started with the sections, the details of your module. And in this, we solved the depreciation first from my notes and the examples that are there. Now let me take you to the detailings of the pointers. So first point that is given in section 32 is that the charge of depreciation is mandatory. What do they mean by this? When they are saying that it is mandatory, it means that whether or not you want to claim a deduction or whether or not you have claimed a deduction, the law presumes that every year a deduction has been allowed. So even if you have not claimed a deduction, your WDV for the next year will get reduced by the amount of depreciation which is eligible in this year. So even if you do not claim the depreciation, your WDV will be reduced by the amount of eligible depreciation. Now, what are the conditions? The conditions have to be read with Rule 5. If you remember, we had discussed this also, section 32, read with Rule 5, brings out the entire provisions for depreciation. So first is, the asset in respect of which depreciation is claimed must belong to either of the following categories. So they are broadly having two categories. One is the tangible assets, which includes building, machinery, plant, furniture, and the intangible, which includes all types of patents, copyright, etc. Then they are saying, again, those four conditions. The asset should be actually used for the purpose of business or profession during the year. And then they have brought out this condition of if it is put to use for less than 180 days. But it is important to understand allowed will be half of the original rate. Second thing that they have clarified is when we are saying use may be active use or it may be even passive use. What is a passive use? So they are saying that passive use means where the asset is kept ready for use. So many times we have a standby machinery. We have an additional equipment which is always kept in reserves, so that in case your main machine or main equipment fails, your production should not be stopped. That is a standby equipment. Another very best example of this is a fire extinguisher. You may in reality never use it, and eventually it may get even expired and you may have to replace the fire extinguisher. Still, it is said to be ready for use and it is eligible for depreciation. So when they are saying the asset should be used, it may be actively used or it may be kept as a standby. Then the assessee must be the owner of these assets, either wholly or partly. Again, where you are owning the asset partly, you are eligible for depreciation for the part of it. Then comes the computation of depreciation. If you remember, we had studied this section 32, subsection 1, clause 1 deals with the option given to power generation units. This is read along with Rule 5.1a. Rule 5.1a says that when you are a power generating unit, you are given an option to calculate your depreciation on SLM basis. Now, how do we know that it is on SLM basis? Because in case of SLM, the depreciation is computed always on the original cost. So this is what is mentioned, that they have given the rates in Appendix 1A of these rules, and in that the SLM rates for different assets are given. This option is available only to power generating units, and it has to be exercised in the first year of that particular power unit's life. Whatever option they exercise, whether SLM or our WDV, which is block method, that will remain permanent for the lifetime. The second method is the block, which is applicable to everyone, the details of which are prescribed in Rule 5(1), the previous session. And then whatever calculations are to be done, they are to be done block-wise. Then we have this concept of additional depreciation. Additional depreciation is always allowed at the rate of 20% on the actual cost. It will be allowed only in the first year. Now, if in the first year the asset is put to use for less than 180 days, so you will be allowed half as per our rule. So only 10% will be allowed. In that case, the balance 10% will be allowed in the first year. But where in the first year it is allowed half, the balance half can be claimed in the next year. Thereafter, that asset will never be eligible for additional depreciation. Again, whenever you buy a new asset, the new asset will become eligible for additional depreciation again in the first year. Then they have given on what items additional depreciation is eligible and not eligible. I had given you a simple rule. It is available on new plant and machinery which is used in production and which is not having the depreciation rate of 100%. Then a question had arisen whether additional depreciation can be allowed to those assessees engaged in the business of printing or printing and publishing, because the query is that can it be said that a printer is a person engaged in manufacturing, because additional depreciation is allowed only to manufacturers. So what is clarified? The business of printing or printing and publishing leads to manufacturing, and hence they are eligible for additional depreciation. Now, there is this concept of terminal depreciation, which is something very interesting and which is special to this depreciation concept. I'll explain that in a while. Let me first complete the remaining things. Then there is this concept of monies payable. What is monies payable? If you remember, in our working of depreciation, what we do, we take opening WDV of the block. To that, we add the actual cost of the assets which are purchased during that particular financial year. And from that, we have to subtract the sale value of the assets which are sold. You remember this? Now, this sale value which we have to subtract is over here referred to as the monies payable. So monies payable, technically, in simple words, is nothing but the sale value of the assets which you have sold during that particular year, which you have to subtract. So this is what is given in respect of any building, machinery, plant, furniture, includes the insurance value, salvage value, compensation, etc. Where the building, machinery, plant is sold, the price for which it is sold. So in simple words, it is your sale value. Now, this is the depreciation chart or the depreciation table which is given to you. And this depreciation table, somebody was asking me, sir, are we supposed to learn? Answer is no. This depreciation entire block, you need not learn. I'll tell you what are the important blocks that you need to keep in mind. Right? Now, let me take you to my sheet from where we will understand this in even greater detail. So we completed up to this particular point in our previous session. Now there is this concept of terminal depreciation, which I have to explain. But before that, let me complete some more interesting points in this depreciation. Yes, so firstly, these are the rates which in general you're expected to remember, because these are the most common ones that will be required. So if in the question only a block of building is given, it will be 10% because building has 3-4 blocks. But if nothing is mentioned, only building is mentioned, you take 10%. If residential building is mentioned, you take 5%. Furniture, there is anyways only one block, so it is 10%. Plant and machinery, there are multiple blocks, but if nothing is given, you have to remember it is 15%, which is the general plant and machinery in which majority machineries are covered. For motor car, again, there are 2-3 blocks, nothing given, you will take 15%. Computer and its software, 40%. Books, which are required by professionals, 40%. Intangible assets, 25%. Additional depreciation for plant and machinery, irrespective of their actual block rate, it is always 20%. Now, some important points relating to computing depreciation. So we studied that we have to compute the WDV of the block. See, this was the format that we studied. We solved the sum. Now, when you compute this WDV, this is as per section 43.6. Normal depreciation is to be computed on the WDV value. Additional depreciation is computed on the actual cost value. You all remember this. Now, in this format, there are two terms which have been defined and explained. One is this term. For your simple understanding, I have written sales value, but the law says money is payable, which we just saw. It means the sale value of assets sold, demolished, discarded, etc. Second thing, what they have defined is what will be included in this actual cost. See, you are going to get deduction of depreciation, and what will be included in the block will become eligible for calculating the depreciation. Now, we include the actual cost of every asset in the block. Now, the question is, what is actual cost? That is what we try to understand now. See, what is this actual cost which has to be included in your block? So for this, the first thing is that actual cost is defined under section 43 bracket 1. And let me tell you, the definition is copy paste of what you study in accounts. In accounts and depreciation, if you remember, what was taught to you is what value has to be capitalized for every asset. It is the purchase cost of the asset plus all incidental expenses till the asset is ready for use. Same principle of accounts is followed over here. If we take the purchase cost of the asset, in that we will add all these expenses, freight, taxes for which GST credit is not allowed. If GST credit is allowed, we will not include it. Then installation expenses, trial run expenses, etc. And from this, we will exclude. What we will exclude if there is any subsidy or grant given by government for the cost, because that much cost actually we are not bearing. So to that extent, the cost will be reduced. Now, there are some special pointers given relating to this actual cost. Now, this pointer, what we are studying or whatever we are studying today, majorly is the procedural or the legal theoretical part. Please don't generally what students have a question is that, sir, whether we need to learn it. So that is what I'm trying to say. You need not learn this verbatim. Yes, but you need to know these pointers because you will be asked these questions, or one of these points may be asked to you in the MCQ type of question. So last time also somebody asked me, sir, whether we need to learn this. For this, the same answer is you don't need to learn this verbatim. But you need to remember these provisions. That is why I'm trying to give you the logics of these provisions, because this will be required when you are answering the MCQ type of questions. Now, what are we trying to discuss is that in the block, we have to add the actual cost of every asset. The general rule is actual cost means this, same like accounts. But there are some special case scenarios given in which the actual cost may not necessarily be your purchase cost plus expenses. It may be something else. Now, the point is that they have created some around 25 different case scenarios in which they have tried to tell you what would be the cost. It is very difficult to remember each and every 25 case scenarios, but I have bifurcated the case scenario into broad three categories. If you understand these three categories logically, it won't be difficult to remember and understand this. So according to me, there are three broad categories in which all these special case scenarios of actual cost are covered. So first category is where some benefit is derived. Now, what do I mean by benefit? Benefit mainly means you have already claimed some deduction for this asset. Now, if you have already claimed deduction for this asset and now you want to claim depreciation, the simple logic is, please understand, student, the logic. You have spent rupees 100 on the asset. Out of this 100, you have got the benefit of 25. Benefit means you have taken deduction. Now, logically, please think logically. If out of 100 you have already taken benefit of 25, why will I give you now depreciation on entire 100? Logically, I should give you depreciation only on the balance 75. This is what is the first category in which, as you can see, some 7 case scenarios are covered. What is this category? I have named it as where some benefits are derived. Now, see, no such categories are given in the law. I have taken all the case scenarios, all the 25 case scenarios, and tried to categorize it so that it is easy for you to remember all 25. So first broad categorization is where you have already been allowed some benefit of that particular asset's cost. Now, in this case, what should be the cost that you will include in your block so that you can claim depreciation on it? The answer is whatever was the original cost, in my example 100, minus whatever benefit you have already derived. In other words, think of this logically. The logical point is, for you, the cost will be 75. This is what you will add in the block so that this 75 will become eligible for depreciation. I hope this is clear to you all students. See, there are so many provisions, so many sections, but it is not difficult to understand. Yes, it may be slightly challenging to keep in mind so many things, but if you go by the logics, I believe on the basis of logics, it is even possible to keep majority of this in mind for the purpose of exams. So, students, any doubts till this point? Any doubts, students? Good. Okay. Now, if you have understood this basic logic, what I'm trying to explain, let me then take you to the different case scenarios covered here. So first case scenario is where your asset was originally brought for the purpose of scientific research. You use that particular machine, that equipment for carrying out research. After 4 years, when the research got completed, still the machine is useful. So now you are using it for your day-to-day business activity. Now, the moment you are using it for day-to-day business activity, what is the deduction that you claim on such assets which are used in day-to-day business activity? The answer is depreciation. Now, here, till date, the asset was used for doing scientific research. Now I am using it for regular business for which there is depreciation. When I will add this asset in my block, please understand, since the first 4 years it was in scientific research, it was not included in block, because in block we include only those assets which will be used for the purpose of your day-to-day business activity. Since it was not used for business activity but for doing research, it was not included in block. Now I will add it in my block in the 5th year. But the question is at what value? The answer is nil. Why nil? Because of this same logic. My cost is 100 and I have already got deduction of 100 where in scientific research. We have already seen that where you are doing in-house scientific research, you are allowed deduction even for capital expenditure. It is exception to one of our rules. So when you have already claimed deduction of entire cost in some other section, how can I allow you deduction for the same thing in depreciation? I can allow you deduction only at one place. So I've already allowed you the deduction in scientific research because capital expenditure on scientific research is allowed. You claim the entire 100 rupees as deduction under section 35. Now I cannot give you a deduction here. So as per this logic, the cost to be taken will be nil. Again, as per the same logic, where you are engaged in any of the businesses, the list of which we are going to read today, these are called as special businesses covered under 35AD. What is the special point of these businesses? Those people who are engaged in these businesses, who they are mentioned in 35AD, for them, entire capital expenditure is allowed as deduction. So again, you are in this particular business where you have already claimed the entire deduction under this section. Now, where entire 100 rupees are allowed to you as deduction under some other section, for the purpose of section 32, for the purpose of law, the cost should be taken as nil. However, there is some exception over here. This exception, I'll explain in a while when we study in detail section 35AD. Over there, you will get this particular logic. Now, same thing applies to all the remaining cases. Your asset was acquired outside India. So you are using the asset outside India. Now you bring it into India and you start using it in your business. What will be the actual cost? The actual cost will be the cost at which you purchase or acquired minus whatever depreciation you have a claim or whatever depreciation was allowable outside India. Similarly, you had a building which you were using previously for your personal use. So you were staying in some flat. After getting qualified, you started your practice in the same flat. So the building which was already in use, personal use, is now made your office, that is brought into business. Again, what will be the actual cost? It will be the actual cost minus the depreciation that could have been claimed on this building if it was covered under business head. Next, you are in exempt business. Now your business becomes taxable. Now, since you are in exempt business, obviously there was no need to compute depreciation because your entire income was exempt. So now what will be the actual cost? It will be the original cost of asset minus depreciation as per your books of account. So even though in income tax it was exempt, but you were claiming some depreciation in your accounts. So that would be deducted. So if you can see the logic, students, please see the basic ideology over here is where you have taken the benefit of that cost somewhere under some other provision, under some other scenario. Here you cannot claim the deduction again under section 32 of that much cost. So whatever benefit you have derived, that will be deducted. Next case scenario is you have paid some duty taxes. Now, we study in GST that whatever indirect taxes we pay in the form of GST, generally it is allowed to you as input tax credit. So it becomes a benefit for you, which can be used later by you when you have to pay your output tax. Now, similarly, when you purchase a asset, at the time of purchase, you incur the GST also. Now, whatever GST you have paid, that is excluded. It means it should not be included in your cost if you are allowed the credit of that GST. Similarly, at the time of import, we have to pay customs duty. Customs duty is not allowed as credit anywhere. So customs duty will always be added to the cost. So whatever duties and taxes, credit is not allowed, that is added to the cost. If the credit is allowed, it should not be included in the cost. And last is where you have received any subsidy or grant or reimbursement by the government towards the cost. So you spent 100, but later on, as per some scheme, 40 was refunded to you. So you have got the benefit of 40. In this case, your cost for the purpose of depreciation has to be 60. So in all these scenarios,
even though covered under different provisions, the same logic is flowing. That is why I clubbed them into one category for easy remembrance and understanding. Now, the second category which I could identify is those cases where assessees are trying to do some jhol in their books, some wrong manipulations in their books, whereby their intention is to evade tax. Now, how can anybody evade tax in the depreciation? Answer is very simple, where you are trying to show higher cost. By showing higher cost, what will happen? The amount of depreciation that you calculate, which will be reduced in your income computation, that depreciation amount will also increase. So by showing higher cost, you are getting an undue benefit. Now, if this is not correct, if the extra cost or the higher cost which you are claiming is illegal or is not as per the law, that should not be allowed to be taken as your actual cost. That is what is my second category of tax evasion cases. In this first scenario is, you have purchased a second-hand asset. Now, please understand, students, for second-hand assets, there is always a great scope of manipulation. Why? See, when I buy a brand new asset, example, I buy a brand new car. Everybody knows what is the real price, the true price of that car, let us say rupees 25 lakhs. But if I'm buying the same car, which is second hand, which may be 6 months old, 1 year old, nobody can say with surety whether that car will be of 20 lakhs or 15 lakhs or 20 lakhs. So there is a very good scope that in case of second hand asset, I may have purchased something for 10 lakhs. But since I want to do jhol, I want to take extra benefit, I am purposefully manipulating the records, I'm manipulating the transactions to show the 10 lakhs as 18 lakhs. Now, if I'm showing a higher cost and I'm doing this by doing some adjustments, manipulations, so what will happen? 18 lakhs is included in my cost of acquisition and I will be getting depreciation on 18, which is incorrect because I should get only on 10. But who will determine whether 10 is correct or whether 18 is correct? So for this purpose, whenever you are buying a second-hand asset, whatever cost you are claiming that this is the cost at which I have purchased the asset, it will be determined by the officer. So your income tax officer, assessing officer has the rights to cross-check and verify whether your cost shown is correct. Next type of adjustment that people were doing was, let us say I'm using some machinery which I had purchased for 100. Over the period after depreciation, the WDV has become 8. The machinery is still useful. I can still use it for next 5, 7, 10 years. But now, if I continue using it, I will get depreciation on 8, which will be very low. So what people did is, they showed that they sold this machinery for 8, maybe 7, maybe 9, maybe 10, means at the nominal value only they sold it. And they also repurchased the same machinery. Let us say for rupees 90. So what they did is only a book entry, a book adjustment, whereby they showed that this asset is sold by them. They will sell it at the book value only so that there is no capital gain or there is no problem of paying any tax. And they repurchase it at a higher price. So asset sold and repurchased. If any such type of adjustment is found in the books, obviously it is a clear-cut indication that there is some jhol going on. You are trying to manipulate something. So the law says, what will be the actual cost? It will be lower of 1, WDV in your books at the time you have sold the asset. In my example, it is 8, or my repurchase price, which I am trying to show as 90. So they are saying we'll take the lower. So even if you have repurchased it at a higher price, no problem. The cost will be 8. Same thing, after government made this particular provision, people started doing some other adjustment. What? They sold the asset, and instead of repurchasing it, they again took back the asset under lease, under a hire. So instead of repurchasing it, they took it under lease method. But the same thing they tried to do. So again, now what they are saying, what will be actual cost? It will be WDV in your books at the time you have sold. So where you are purchasing the same set or you are taking it back on lease, we will take your WDV in the books only, which was there originally. So there will be no scope of manipulation. Whole scenario which is covered in this is what we have already studied in section 40 capital A bracket 3. That is where you are making payment for a transaction to a person in a day exceeding rupees 10,000. The payment has to be made only by way of account, pay, check, draft, or prescribed electronic medium. Same rule applies for cost of asset also. So if you have purchased any asset, and by default for any asset, the value will be about 10,000. So you should ensure that the payment for that asset is made only by way of account, pay, check, draft, etc. If the payment is made in cash or bearer check or even cross check, it will not be allowed. You cannot add anything in your actual cost. You will not get depreciation. Then coming to a third case scenario. Now this case scenario, you may not appreciate the logic much now because this is more connected with the capital gains chapter. So the impact of this, you will understand more in the capital gains chapter, but I'll tell you what this case scenario is. So let us say there is a building which is owned by your dad. Now let us say dad has purchased the building 10 years back. So he had purchased the building in 2005. Sorry, this is 20 years, 2015. Now you qualify, you become a chartered accountant. So you want to start your own office. But dad says, see, this building is there. What you can do is you can start using this building and your dad gifts you this building in 2025 and now you are using the building. This can happen with any asset. Now, interestingly, when you have bought the asset by way of gift, practically, there is no cost which you have paid. So anything which is acquired by you by way of gift, will, inheritance, there is no cost that you are paying. But the law says we will take a cost. What will be that cost? That cost will be the cost to your previous owner. Now that is the previous owner because you are the current owner. So at whatever cost or price dad had purchased this, that will become cost for you. Now, in this case, since dad had used this building, so cost minus depreciation, that is also including the above point that we had discussed. So the WDV, whatever it comes today, that will be the cost for the purpose of claiming depreciation. So the point is that where you have acquired the asset in one of the specified mediums, which is mentioned over here, and this entire thing is borrowed from capital gain. The same provision you'll find in capital gains chapter, that where you have acquired asset by any one of these means, for you, the cost is cost of previous owner. What are these means? You have acquired the asset by way gift, will, inheritance, or you are 100% holding, or you have a subsidiary of which you are 100% holding, and there is a transaction between holding subsidiary. That either holding has given to subsidiary or subsidiary has given to holding, or where the company is formed by amalgamation. So the old company transferred this asset to the new company, or same, the company is formed by demerger, old company transferred the asset to the new company, or it is corporatization of stock exchange, or it is conversion of a company to LLP, LLP to company, or proprietor to company. All these case scenarios are covered, or it is a succession of business. So business was run by dad, later on taken over by daughter. This is succession. In all these case scenarios, for you, the cost is cost of previous owner, or here they have mentioned whatever is the cost for WDV in the hands of the transferor. I'm using the word previous owner because the same thing you'll find in capital gain. So you should not feel that you are studying something different. Same provision applies in capital gain also, because in capital gain, when you sell this asset in future, you have to compute your capital gain or loss. For that, what is your cost? Because you may have got the asset free. So they are saying in all these case scenarios, for you, the cost will be cost of your previous. Students, have you all understood this? Anybody having any questions or doubts? Students. Yes, beta. Somebody raised hand. Okay. Anybody? Any question? No questions? Wow. Okay, even the technical things you are able to comprehend now. If asset put or purchase this year, but put to use in the next year, then 180 days provision will be there. But additional provision will not be there. I think some language problem is there, but what I have understood, I'll explain. So let us say you purchase the asset in this year, right? But put to use in next year. And in the next year, you have put to use for less than 180 days. So I'll give you an example. You purchase the asset somewhere in January, February of this year. That is in the previous financial year. But for some reason, you did not put to use. It was petty pack kept aside. Then you decided to put it to use in this year. But this year also, it crossed 2nd, 3rd of October. So you put to use after 180 days. Now, please pay attention, students, to the rule. Since the previous lecture, I have been saying this, where the asset is purchased and in the same year it is put to use for less than 180 days, the rule is of half depreciation. Where the asset is purchased in 1 year but put to use in another year, even though it is put to use for less than 180 days, you will not take half depreciation, you will take full depreciation. Point number 1. Second, whether additional depreciation is allowed, answer is yes. Additional depreciation is allowed. There is no restriction that here you cannot claim additional depreciation simply because you started using asset in the 2nd year. The point is, you can claim additional depreciation only once. See, regular depreciation you will keep claiming every year. But for additional depreciation, it has to be claimed only once. So generally it is said it is claimed in the 1st year. But if you have not put to use the asset in the 1st year, then by default it will be claimed in the 2nd year. So that does not mean that you will not be allowed the claim of additional depreciation. Okay. Tej has some doubt. Yes, beta Tej.
सर मेरा डाउट टैक्स इवेजन के 4th केस में है। आपने कहा कि 10,000 से ज़्यादा अकाउंट पे या ड्राफ्ट के सिवाय कैश में या किया तो फिर नहीं मिलेगा हमें उसका डेप्रिसिएशन, लेकिन आधा कैश में किया और आधा अकाउंट पे से किया तो
जितना आपने अकाउंट पे से दिया बेटा उतना आप अपना एक्चुअल कॉस्ट दिखा सकते हो। करेक्ट? Whatever you have paid in cash, वो आपको इग्नोर करना है। Yes, Harshada, it is possible that WDV is nil while transferring. So if WDV is nil, so आपके लिए रूल क्या है? जो भी WDV है वही कॉस्ट बनेगा, so cost will be nil. Soumya, can additional depreciation be claimed on imported machinery? Yes. Why? See, if it is a plant and machinery, if it will be used in your production activity, you are a manufacturer, it is a new plant and machinery, it is allowed. Correct, Soumya? Now, unabsorbed depreciation. What is unabsorbed? Unabsorbed means in this year, you could not claim that entire depreciation deduction. Why? Because your income was less. So when your income is less, in accounting language, we say there is a loss. In income tax language, we say you could not absorb your expense. So it is simple like this. My sales are 100. I have all my expenses. Let us say all the expenses other than depreciation are 105 and depreciation is 15. So in the accounting language, we will say you have a net loss of 20. Income tax say we don't call this as net loss. We will say that you could not absorb your 20 rupees of expenses. So 20 rupees is your unabsorbed expenses. Unabsorbed means that much expenses you could not pay because you did not have the revenue. You could not manage the expenses out of your revenue because the revenue was less. That is why it is called as unabsorbed. Now, in this income tax law says that total 20 is your net loss as per accounts. From our side, we will say that out of 20, 15 is your unabsorbed depreciation. So you can simply say loss because of depreciation. And 5 is my other business loss. Other business loss means loss because of my other expenses like purchases, wages, rent, etc. So where there is a loss, they say that treat the loss in 2 parts. Loss because of depreciation and loss because of other expenses. Now, as we go to further sections, they will say that, okay, same like depreciation, treat the loss because of capital scientific research and because of family planning also separately. So had there been my P&L had even these 2 expenses, that is capital expenses on scientific research or family planning, I would have treated my loss separately for them also. But generally, these are very rare expenses, so we will not consider them. Generally, depreciation is there in every case. So depreciation is always there. So income tax will say that out of 20, we are saying that 15 is because of depreciation. So we call it as unabsorbed depreciation. And remaining 5 is because of other expenses. So we will call it as other business loss. Now, when you go to the set-off chapter, the set-off chapter explains you whenever there is a loss, how to deal with that loss. The answer is you adjust the loss from other incomes. This is what is called as set-off. So setting off means adjusting your loss against other incomes. In this particular case, how to do that? For this, when we talk about unabsorbed depreciation, the law says that you can adjust it against other incomes except income under the head salaries. So any business loss cannot be adjusted from salary head income. Just keep this in mind. This you will study in detail when you study the set-off chapter. So if there is an unabsorbed depreciation, that is a loss because of depreciation, you cannot set it off against income from salaries. You can set it off against HP, you can set it off against capital gain, etc., but not against salary. Also, you cannot set it off against winnings. So where you have winnings in the form of betting, lottery, nowadays online gaming, against these incomes, you cannot set off your business losses. Second, if this loss could not be set off at all in this year, why? Because you do not have other incomes, then you can carry forward this loss. Now here is the difference between other business loss and the loss because of depreciation. If it is other business loss, you will study in set-off chapter that this can be carried forward for 8 years. However, if it is because of depreciation, which we call as unabsorbed depreciation, it can be carried forward for any number of years. So no time limit provided for carrying forward the loss because of depreciation. So this is the important point about carry forward and set off. You study the carry forward and set off in much detail when you come to the topic of set off of losses. Okay. Now I have to explain you another important section 35 AD, but before I go to that section, let me explain you something else. What is this something else? There is a concept called as terminal depreciation, and there is a concept called as balancing charge. Now, these both appear to be technical, but they are very common sense and logical points. Let me explain you this. Now, when these two concepts are applicable, they both are applicable when your depreciation is allowed under the SLM method. So when you are claiming depreciation under SLM means for the power units only, then only this concept of terminal depreciation or of balancing charge will come. How? I'll explain. So let us say cost of your asset is 100 and the life is 10 years. So logically SLM depreciation per annum is 10. So every year you are claiming depreciation of 10. You have used the asset for 3 years. So 10, 10, 10. Total depreciation you have claimed till now is 30 rupees. And obviously the WDV in your books is 70. Now we are in the 4th year. What happens in the 4th year? You sell this asset. So you are selling the asset, your asset is sold. Now there are 3 possibilities. For what price your asset is sold? First possibility is your asset is sold for rupees 63. Second possibility, it is sold for rupees 81. Third possibility, it is sold for rupees 126. So this is the sale price of your asset. Now, simply put, if I want to find out profit or loss of this asset, how do I find out profit or loss in accounts? From this sale value of the asset, I will deduct the WDV. Now, how much is the WDV? Cost was 100. I have claimed depreciation in 3 years of 30 rupees as per 10 per year. So my WDV of this asset is coming to rupees 70. Yes, Maruti, correct. Now see the beauty. In your accounting sense, you will say there is a loss on sale of asset of 7. There is a profit on sale of asset of 11. There is a profit on sale of asset of 56. Correct? Income tax says no. It says this is not a capital loss. See, if it is a profit or loss on sale of asset, in the language of income tax, it should be called as a capital loss. But PGBP and capital gain provision says no. We will not call it as capital loss. In fact, this 7 rupees will be treated as your last year's depreciation. Last year means 4th year. 4th year is your last year because you are selling the asset in the 4th year. And since this is the last depreciation, that is why it is called as terminal. Terminal means end. That is why many stations are called as terminus. Bandra terminus, Bhusawal terminus, Jalgaon terminus. All these are called as terminus because that is the end where some train's journey ends. So terminus, terminal means the end. Now, since this asset is sold, this is the last time you are claiming depreciation. So this depreciation is the terminal depreciation. And it is nothing but the difference between the WDV and the sale price, where WDV is higher. So in your accounting sense, you say it is a loss, but income tax says don't call it as a loss because we are not going to treat it as a capital loss. Rather, we are going to treat it as a deduction in PGBP under section 32 called as terminal depreciation. Fine. Now something even more interesting. I have a profit here and here. Again, in your accounting sense, in your accounting language, you will say this is profit on sale of asset. Income tax says, sorry, don't call it so. Because the moment you call it as profit on sale of asset, it becomes a capital profit, it will go to capital gain. No, we will consider it as our PGBP income under section 41. So it is a section 41 income. I hope you all remember 41. There are only two sections for income under PGBP, 28 and 41. 28 covers receipts, 41 covers past expenses which are now reimbursed, refunded. See the beauty. What is the beauty? PGBP, CG, or let us say entire income tax law says, this is not a capital profit. This is my PGBP income as per 41 section. How? 41 is what? Past year's recovery of expenses. This is the same. How? That is the point. So Dhanush, that is what I'm asking you. Firstly, how it is an income under PGBP. If you understand this, you'll understand why it is section 40. And what was section 41, Dhanush? Past year's expenses now recovered, reimbursed. It is the same. How? Let us understand. See the logic. Understand, your asset is of what price or cost? Your asset is of 100 rupees cost, not 70. 70 is a book value which you have calculated by deducting 30 rupees as depreciation in 3 years. Originally, the cost of asset is 100, reduced to 70 by claiming deduction in 3 years of 30. Now, the logic is, if you are recovering anything above 70, like here, I'm getting 1. So whatever I'm recovering is I'm first recovering this deduction of 30. So when I'm saying I've got this 11 profit, it is not profit. You had reduced your cost from 100 to 70 by showing a depreciation of 10 per annum, taking total 30 deduction in last 3 years. So when you are getting this 11, it is recovering that 30 rupees. So in this case, 11 is my PGBP income under section 41, subsection 2. Similarly, when I get a profit of 56, when you are getting a surplus, let us call it a surplus for the time being, exactly what you are getting is you are first recovering this 30. So out of this 56, 30 is again PGBP income under section 41(2). Why? Because you are recovering that 30 first, which is nothing but the past 3 years deduction. This is how it is section 41. Now, whatever excess you have recovered, that is 26, will go to CG. And if I have to explain it differently, see, I have sold it for 126. My cost was 100. So how much I'm getting above the cost? 26. That is what is my true profit on the capital asset. So that 26 you consider in the capital gain working. See the beauty. See the logic. Students, did you get the beauty of this? But a 7 is again not loss now, but I already explained, Ishan. 7 is also your PGBP deduction. It is the deduction towards depreciation in the last year. So it is also deduction, not a capital loss. Ha, Harshada, good comment. Now I understand why businessmen need CA. But Harshada, more than CA, here what is to be understood is what would be the level of the lawmakers when they would have drafted this law. See, we are coming next because we are interpreting the law what is already drafted. But the first thing is the draftsmen, the lawmakers, when they would have drafted the law, just think to what extent they go and think before drafting a law. Today we find interpreting the law so difficult, so tricky, so jumbling. But think about them, they have to draft the entire law. So 100 rupees is the cost, I'm repeating. Depreciation in 3 years is 30 on SLM basis. In this particular case, first case scenario, you have sold it for 63. So 63 sale price, WDV is 70. So there is a 7 rupees negative surplus, I will say, instead of using the word loss. Income tax says it will not be treated as a capital loss. Show it as a depreciation under section 32. Name it as terminal depreciation. Why terminal loss? Because after this, you will not get depreciation on this asset because it is sold. So this is the last depreciation on this asset. So call it as terminal. And in other cases where there is surplus, this surplus is not actually your profit on this asset. It is firstly the recovery of this 30 rupees, which you have already reduced from the cost of the asset and shown it as a deduction in PGBP. So when you are getting this surplus, it is actually getting that 30 rupees back first. So until you are recovering up to 30, like in first case, you have recovered only 11, the entire 11 is PGBP. In the second case, you have recovered more than 30, up to 30, it is PGBP. Over and above that will be your CG. Hope I'm able to explain this very beautiful concept of income tax. And I hope everybody of you has understood this. Now I'll tell you a beautiful point. Even accounts does this. Listen to me. Even accounts does the same thing. How? In accounts, whenever you have a profit or loss on sale of asset, you don't consider it as a capital loss or a capital profit. Because had it been a capital profit or loss, you cannot show it in P&L. P&L always shows only revenue incomes and revenue losses. But when you put the profit or loss in P&L, it means you are treating it as revenue only, same like what we are doing in income tax. This is, we are showing the loss as revenue expense. This is, we are showing the income as revenue income only. And this thing, even in accounts, is shown as capital reserves. So in accounts also, if you get a profit on sale of asset in this scenario where your sale price has exceeded the cost of the asset, but this may not have happened till now in whatever depreciation sums you have sold, where you have sold the asset. This may not have happened. So you have simply put the profit in the P&L credit side. But where you have sold the asset for a price above the cost, the excess, even in accounts, is to be shown in capital reserves. The read accounting standard relating to, earlier it was called as AS10 fixed assets, now it is called as PPE. Correct? Property, plant, equipment. That accounting standard which deals with assets, which covers depreciation, also covers this point also. So what we are studying now is not something different than accounts. Same thing accounts does. Logic you have understood today. Normally I ask this question whenever I start a topic. Key, whether this profit or loss on sale of asset is capital or revenue. Everybody says, sir, it is capital. Then immediately I ask the next question, then why do you debit credit it in P&L? For which nobody knows the answer. But this is the reason, because it is not a capital profit or loss. And even income tax does the same thing, even accounts does the same. It is a capital profit only in this case. And this is where even the accounts will ask you to transfer it to capital reserve, which will be carried forward in balance sheet under the name capital reserves. Sir, so in case 7 is terminal depreciation, acha 17. And in case, acha 7, okay. In case 11 is not terminal. Beta to, Ishan beta, how can you ask this question? When I'm getting surplus, how can surplus be my expense? It will be income only, na? Depreciation is an expense. Expense will come only when it is negative. When it is positive, it has to be income, na? Rajveer, we debit or credit. Correct. Shalini, brilliant calculation. Already tax, allow deduction. Then why? Again, allow deduction in the name of profit. Again. Then why Adain? First, will record the deduction, depreciation value, then allow as capital gain. Shalini, sorry, I did not understand what you want to say. Okay. Done. So, we did first major section, a brilliant one. Yesterday, that is in the previous session, we did the practical working that gave us some insight about depreciation and its logic. Now, we are doing the theoretical part. Right? Let us proceed. Now we go to the second interesting section. We have heard about this section right from start, section 35AD. What does 35AD covers? It covers a list of some eligible businesses. What are those eligible businesses? The list you can read, like it covers cold chain facilities. It covers warehousing for storing agricultural items. It covers the business of laying and operating cross-country petroleum gas pipeline. Then it covers a hotel, which is of 2-star or above category. Then it covers hospital, which is having at least 100 beds. So this is a list. This list keeps on changing. Now, these all businesses are called as Section 35AD businesses because this list is given in Section 35AD and the list has different dates because, as I said, this list keeps on amending. So the date from which that particular business is brought under this section, that date is given. Please don't worry, you need not learn the dates. Now, what is important about this is that where you are engaged in any of these businesses, the special provision under 35AD says, I will give you deduction of, see, all other regular deductions you are getting, revenue expenses. Most important point, I will give you deduction of 100% of capital expenditure. That is why in depreciation we just studied, the cost will be 0. Why 0? Because you have already taken full deduction here. So we give you deduction for entire capital expenses, except no deduction for land. Anyways, this is not allowed anywhere in any section. Next, no deduction for goodwill, because many times goodwill may be only a valuation in books, like we call it as fictitious asset. And third, for financial instruments, like you have invested in other companies' shares, debentures, bonds. So anyways, these are not assets of your business. They are investments outside. So other than these, all other assets of your business don't take depreciation. Why? Because I'll give you entire cost as deduction in the year of purchase itself. In fact, even if you have incurred or purchased these capital expenses before commencement, like preliminary, and many times it happens before starting your business, you invest in building, you even buy machinery, or you make the entire setup ready, and then you start the business. Even expenses done before commencement in the form of capital are eligible. So as a corollary, since I'm giving you deduction of entire 100 rupees immediately, no depreciation is allowed. Now, what is important is that since This section will give you deduction if you have started one of these businesses, and when you have started, they have given dates. That is the dates from when the business is added in this sections list. If you have started business after that date, you get this deduction of capital expenses. Now they are putting some conditions for such businesses. One, the business should be a new business. Means what? It should not happen that some old business you have restarted by doing some internal changes or some cosmetic changes like splitting up or reconstruction. So it should be a new business. Old business should not be restarted. Next, the plant and machinery which you are purchasing for this business should be brand new. However, if you are importing machine, old imported machines are allowed, second-hand imported machines are allowed, and even the machines which you are purchasing from India, out of total, up to 20% of second-hand means old machines are allowed. So, for plant and machinery, condition is, in order to be classified under this section for getting deduction of capital expenses, plant and machinery should be new. And when they say new, they have given 2 points as a relaxation. One, imported plant and machinery can be old, allowed. And if you are purchasing within India, that is domestic plant and machinery, up to 20% old is allowed. Next. Again, since I am giving you deduction of capital expenses, if this capital expenses value exceed 10,000, you have to follow the conditions of 40A3, means the payment should be not in cash or by cross check or by bearer check. It should only be by account pay check. Same condition. Next. Now this is going to be interesting again. Please understand. You have purchased the asset for 100. Now, you are selling this asset. So either your asset is sold, which is the word you just transferred, or it is demolished, destroyed, for which you are getting insurance claim. Please understand, when you purchase this asset, I gave the entire cost as deduction under this section 35 AD. Now, this happens on purchase. So entire 100 rupees is your deduction. Now, when you sell this asset, let us say for rupees 20, please understand what is happening is, again, there is no capital gain or loss. Why? Because it is as good as I'm recovering back this deduction. I am recovering back this deduction. So they are saying, whenever you are selling the asset, and for this asset, you have claimed the deduction under 35 AD, that is, you have taken the cost as deduction, then whatever amount you are receiving on sale will be taxed under the head PGBP only, and that is why they have given reference of section 28. So it is your income under section 28. And if you remember section 28, when we studied, I had left last point. I said I'll explain that point when we will study 35 AD. So this was the last point. What it says, sum received on account of capital asset referred to 35 AD. So when this asset is sold or demolished, discarded, etc., the sale value, that is a sum received, will be considered as PGBP income. Again, no capital gain, no capital loss. Same logic. Because I have taken entire 100 rupees as my deduction. So when I'm selling it, what I'm actually doing is I'm recovering that 100. So past expense is recovered now. It is PGBP income. Correct? Now coming to something even more interesting. Yes, Asta, you are correct. Now, something even more interesting. Pay attention. I am under 35 AD business, and the asset I have purchased for one of these specified businesses. Specified means the names which we studied or the names that keep on updating in that list. So whatever business names are covered in this list, they are called as specified businesses. Now, I have purchased an asset. Again, let us say for rupees 100. And since my business is one of this 3580 business, I have got the deduction of this entire 100 under 3580. The entire 100 rupees is allowed to me as deduction. However, what I do is, before expiry of 8 years, that is before 8 years have ended from the date of purchasing the asset. So let us say, for example, I have used this asset for 5 years. 5 years for what? For this specified business. After 5 years, I transfer, or now I'll use a word, shift this asset from the 3580 specified business to any regular business. I'll give you an example. I constructed a building. This building I constructed for being used as my corporate office for this business, which is 3580. What is this 3580? Let us say I'm running a hotel. So I constructed a building and I'm using it as a hotel, satisfying the conditions of 3580. So this hotel becomes an asset under 3580 business. Entire rupees 100 crores spent on construction is allowed as deduction. 5 years I run the hotel. Now, since the building has become old, people don't like coming to old places. So I construct a new hotel with much better amenities, view, ambience, etc. And I'm having one more business. I'm running a factory where I'm manufacturing some automobile parts. Now, factory manufacturing automobile parts is not covered in 3580 list. In this factory, I have many workers for whom I require some space to stay. So what I do is, this hotel, which was till now used as a hotel, I now construct a new hotel. So that new hotel becomes my hotel. And this building, which was till now used as a hotel for running a hotel business, is now used as my workers' residence, where I accommodate my different workers in the various rooms of that building. So this is where I will say that I have shifted that asset from a specified business to my regular business, because now this building is used for the purpose of my manufacturing business because the workers working there are staying there. Now the interesting point is, I have not sold this building to anyone. The building is with me only. But in the eyes of law, I have changed the usage of the building from this 3580 business to any other regular business. Importantly, what does the law say? I gave you the deduction for entire cost. But why? Because you are using this asset for 3580 business. Now, since this 3580 business is over means at least you're not using this asset for that business. So technically, you are not eligible now. Now, if you're not eligible now, what to do? So they have said, we are giving you a limit of 8 years. That is, you should use any asset for minimum 8 years in this specified business, then no problem. But if before expiry of 8 years, you start using this asset in any other business, which is not 3580, or not eligible under 3580, then there is some tax implication. What is this tax implication? I will find out notional WDV. Notional means not real, only on paper. How? 100 rupees was my cost minus depreciation, which I would have calculated if this asset was not a 3580 business asset. So let us say this building right from day one was used in my regular business. Obviously, every year I would have calculated some depreciation on this building. So I will calculate that depreciation. Now this building is used for 5 years. So I'll calculate the 5-year depreciation, subtract it from 100. Let us say the amount comes to 42. Now this 42 is treated as my PGBP income under section 3580. So it is considered as my 35 AD PGBP income. Right? So it is considered as 35 AD business income. Simple logic. I took deduction of 100 in my 35 AD business. Now that asset is getting transferred from 35 AD to any other business, though other business is my business only, but in the eyes of law, 35 AD is different and other businesses are different. So in 35 AD computation, I will have to show this 42 rupees as my PGBP income. Fine. What about this other business, regular business, where this asset is brought in? Can anybody tell me what will happen in this regular business where I have brought this asset? Think logically. Students. No? Yes, there is some answer. That is my point. Rajveer, good. Only you have to think about additional depreciation again. Very good, Smriti. So that is my point. Can I claim depreciation in this regular business? Because now I'll be using the building in my regular business. Answer is yes. Now the question will be, what will be the actual cost? Applying the same logic. First case, have I got some benefit on this asset? Yes. I had first claimed the entire 100 rupees as deduction. So somebody will say, sir, you've got entire 100 rupees as deduction. But wait, again, out of 158, which is 5 years depreciation was adjusted, and balance 42, they made it taxable again. Means, even though originally they gave me deduction of 100, they took back the deduction of 42. It means effectively I have only deduction of 58. So this 42, which has become taxable in 35 AD business, this 42 will become cost in my regular business. See this point. However, if the asset is transferred to any other business within 8 years, the amount which is treated as income under 35 AD will be treated as cost here. It is very logical, simple logic. So I claimed 100 rupees as deduction in 35 AD. But now when I'm shifting the asset, 35 AD has taken back 42 rupees because they have made 42 taxable. So effectively, they gave me benefit of 58. Now when I bring this asset in this new business, same logic, actual cost will be cost minus benefit. So 100 minus 58, which is the actual benefit which I'm getting. So this 42, which is taxable there, will now become actual cost in the regular business, and I can claim depreciation here. See the beauty of the calculations, students. See, it is easy if you understand with logic. Yes, we have to do shifting from this section to that section. When you go to the law, it is even more confusing because here I have collated everything related at one place. In the law, it is not in such a sequence. But fine. That is why we have some value in market, and our value will always be there because of such complications. So if you remember, I had said this in one of my previous lectures, that whenever you are studying any law and you find the law difficult, tricky, very burdensome, be happy. Say, bless you. Why? Because the more these things are like this, the more will be your value in the industry, in the market. The moment everything becomes easy, now you have all these AIs, you have the Claude, you have the Copilot, you have the Gemini. They will do the work for the businessman. They will type anything and they will get the answer. But such things, no Claude, no Gemini, no Copilot will be able to give answer. It will require you and me. Correct? Any doubts? Now in 35 AD, one more important point. If this business has a loss, again talking something about set-off chapter, important condition is that this loss from an eligible business, means the business which is covered in 35 AD, can be set off only against income of another eligible business. In other words, 35 AD loss can be set off only against 35 AD income, not against any other business income or any other head income. This is not the rule for regular business losses. We just saw regular business loss. It cannot be set off against salary and winnings. Others, all income, you can set off the regular business loss. 35 AD business loss, you can set off only against the 35 AD business income. Sections are done. 32 AD is now no more applicable, so no need to do it. Small sections, donation, preliminary will do after the break. Let me take one more section. Yes, scientific research. So now you know everything in this scientific research, but as a section, let us discuss. निधि सर मॉड्यूल में किस पेज पे है? What बेटा 35 AD और scientific research? हाँ, निधि ने लास्ट टाइम भी बोला था सर मॉड्यूल के हिसाब से चलना है. Yes, I remember now. निधि बेटा, I may not be going as per module because module में भी law के हिसाब से दिया है, may not be connected, but still I'll tell you where it is in the module or we can brush up the module at the end. नहीं तो आप सिंपल एक काम करो ना बेटा, सबसे अच्छी बात मॉड्यूल का बेस्ट पार्ट मैं आपको बताता हूँ. दिस इज द बेस्ट थिंग आई फाइंड इन एनी कोर्स मटेरियल, द लास्ट पार्ट ऑफ योर मॉड्यूल. आपको कुछ नहीं करना बेटा, सिर्फ आपके मॉड्यूल के लास्ट पार्ट पे जाओ. सॉरी, दिस इज द बेस्ट पार्ट ऑफ our institute's books, which will not find anywhere in any other material. See this part. Options in simplified, in reduced version at one place. ये देखो, ये साइंटिफिक मिल गया, ये 35 AD मिल गया. तो अगर आप पूछ रहे हो कहाँ पे मॉड्यूल में, ये रहा बेटा. डिटेल कहाँ पे बेटा वो ढूंढना पड़ेगा, बट लेट अस नॉट वेस्ट टाइम, दैट यू कैन डू इट. समरी में ये रहा, साइंटिफिक रिसर्च ये रहा जो अभी मैं पढ़ा रहा हूँ, जो मैंने ऑलरेडी पढ़ा दिया. 35 AD वो ये डेप्रिसिएशन और ऊपर के सेक्शन हम ऑलरेडी पढ़ चुके हैं, 32 वगैरह. ठीक है बेटा निधि. Now, scientific research, I had already mentioned in my first class itself. Scientific research means what we call as research and development in our normal accounting language, R&D expenses. अब इसमें दो चीजों का डिडक्शन है. वन, यू आर मेकिंग पेमेंट टू सम आउटसाइडर, दैट इज आप खुद रिसर्च नहीं कर रहे या आप खुद रिसर्च कर रहे हो. सो देयर आर टू पॉसिबिलिटीज. मैं खुद रिसर्च कर रहा हूँ बाय सेटिंग अप माय ओन लेबोरेटरी रिसर्च फैसिलिटी, और बाहर ऑलरेडी जो लैब्स है जो रिसर्च कर रहे हैं मैं उनको पेमेंट कर रहा हूँ. व्हेन आई एम मेकिंग पेमेंट टू आउटसाइडर, द पेमेंट मे और मे नॉट बी रिलेटेड टू माय बिजनेस. सो दिस वाज वन ऑफ द एक्सेप्शंस टू आवर गोल्डन रूल. सो जब आप बाहर पेमेंट कर रहे हो, वो आपके बिजनेस से रिलेटेड नहीं भी है, स्टिल यू विल गेट डिडक्शन. दिस इज द इंपॉर्टेंट पॉइंट. मोस्ट इंपॉर्टेंटली, ये डिडक्शन आपको न्यू स्कीम में नहीं मिलेगा. इट इज ओनली अलाउड इन द ओल्ड स्कीम. करेक्ट. अब इसके बारे में यहाँ पे व्हेन आई एम मेकिंग पेमेंट टू आउटसाइडर, कंडीशन क्या है? ये आउटसाइडर होने चाहिए अप्रूव, नोटिफाइड, ये वर्ड्स याद रखो. सो आप जिसको भी पेमेंट कर रहे हो, दे शुड बी अप्रूव्ड, साइंटिफिक रिसर्च कॉलेज, इंस्टीट्यूशन, नेशनल लेबोरेटरी, व्हाटएवर. और आपको डिडक्शन कितना मिलेगा? 100. मैंने मेरे नोट्स के स्टार्टिंग में बताया, जहां पे हमने पढ़ रहे थे कि पहले इधर 125, 175 याद रखना पड़ता था. इट शुड बी रिलेटेड टू योर बिजनेस. Here, if you are doing research which is not related to business, there is no deduction. Here, deduction is allowed to under both the schemes, whether old or new. So both schemes are allowed. Now, in this also earlier, there were two categories, a special and a regular. Special was allowed deduction at a time of 200, then they changed it to 150. Now even that is gone. The best part is 100. So अब हमारे लिए category से भी फर्क नहीं पड़ता है. Simple you are doing research yourself in-house R&D. So when you're doing in-house R&D, that is in-house scientific reference, because we are giving deduction for both. So this was also our exception to the rule of revenue expenses, because scientific में capital expenses का भी deduction मिलता है. It means if you purchase asset for scientific research, you will get deduction 100% for the asset. No need to claim depreciation. So when I'm giving entire cost as deduction, depreciation will not come. How much deduction is there? 100%. Again, which capital expenditure is not allowed? Expenditure on land. Some important points about this is, again, if this expenses remain unabsorbed. Now, unabsorbed में दो possibility है, capital expenditure scientific का unabsorbed या revenue. If revenue expenditure is unabsorbed, treatment is like other business loss. But if capital expenditure on scientific research is unabsorbed, the treatment is like unabsorbed depreciation. What is the difference? ये आप infinitely carry forward कर सकते हो और business loss सिर्फ 8 years तक ही carry forward होता है. Again, all this is part of carry forward set of chapter. Capital expenditure on scientific research carry forward कर रहे हो, any number of years you can carry forward and set off. But if you are carrying forward the revenue scientific, the treatment is same like other business loss, limit is 8 years. दोनों को आप set off कर सकते हो against any income except salary and winnings. So capital scientific हो, revenue scientific हो, यानी unabsorbed depreciation वाला treatment हो या other business loss वाला treatment हो, set off होते वक्त आप किसी भी इनकम में सेट ऑफ कर सकते हो, बट यू कैन नॉट सेट इट ऑफ अगेंस्ट सैलरी एंड विनिंग्स. नाउ नेक्स्ट पॉइंट, नाउ रिलेटेड विथ आवर प्रीवियस डिस्कशन, you purchase the asset for doing scientific research. Now your scientific research is over and you decide to start using the asset for your regular business. So you start using it in your regular business. The moment you start using it in regular business, you show it in block. But what cost will go to the block? 0. Why? Because I purchased scientific research asset for rupees 100. Entire 100 is deduction under 35. That is the scientific research section, because I allow you capital expenditure as deduction. Since entire 100 is allowed as deduction, now there is no scope of taking deduction under 32. So since entire cost is allowed as deduction as benefit earlier, now even if you bring it in your business, under section 32, you cannot get depreciation. So even the asset is added to your block, you will add it in the block, but with amount as rupees. Interestingly, I don't bring it in my asset. I don't bring it in my business. I sell it. What will happen now? Same logic what we discussed some time back. I have sold this asset. The asset was for 100 and I have taken entire 100 rupees as deduction. Now let us say the asset is sold for 81 or the asset is sold for 108. What will happen? This 81 is nothing but the recovery of the deduction which I have already claimed. So this becomes my PGBP income under section 41 bracket 3. And here, since I've got deduction of only 100, my PGBP income is 100 under section 41(3), and the excess 8 rupees will be considered as my capital gains to be treated under that chapter. Same thing we discussed previously. Same logic. Where we discussed this just now in power units SLM depreciation option. Same thing we discussed. Same working you will be taught in case of license fees or spectrum fees paid by telecom companies. This is under section 33. It is not part of your syllabus of inter, so I'm not covering it, but it is same. So the treatment of scientific research asset or the treatment of power unit assets which are under straight line method or of license fees or spectrum fees by telecom companies, when these are sold, the treatment, the logic is same. What is the logic? When you purchase, I gave you deduction of entire 100 rupees cost. Now when you are selling it, you are doing nothing but recovering this deduction, and recovery of past year's deduction is 41 income. So it is income under 41. To what extent? To the extent of deduction. Now if my deduction is of rupees 100, my income under 41 can also be only up to rupees 100. So if it is sold for 81, entire 81 is PGBP. If it is sold for 108, out of 108, 100 is PGBP under section 41, remaining 8 will go to capital gains. Is this clear to you all? Students, understood? Pakka? Sections are interesting. Sections are thoughtful. Yes, too many sections, too many provisions, but I believe it is fun. CG means beta capital gains. Nidhi, आप कहाँ पे हो? Capital gains short form, right from day one I'm saying CG. OS means other sources. HP means house property. Correct? Sure. So we take a 10 minutes break. After this, we'll cover the remaining sections, which are majorly small. Only few, 2 or 3 sections are slightly lengthy, but they are also interesting. So 10 minutes break, right? Yes, sir.
Depreciation under section 41, right? I'm sure I did not understand. If profit. Yes, okay. See, beta, firstly, there is no depreciation here. The reason is the entire 100 rupees was allowed as cost. And now when we are selling that asset, whatever we are recovering out of that 100 rupees. So there is no question of notional depreciation. Fine, you're right. Smriti sir, why is same not applicable for other block of assets? Very good, beta. See, Smriti, the difference between this and other blocks of assets is that in block of asset, there is no identity of individual assets. You do not know how much one asset was costing, because not costing means you are knowing the costing, but when you are adding that asset in block, once you start every year computing the depreciation and adjusting the purchase and sale of all the assets in that block, now after 4 or 5 years, you do not know ki my original asset today is costing how much in the block. So that is why the block runs on a different mechanism. Over there, every year you do add less of purchase sale, and you compute depreciation on the net balance. And here, since you are having independent asset identity, because you are claiming one asset separately here in these sections, that is why this type of working is possible here, but not for block of asset. Fine, beta? Okay. Let us cover the remaining smaller sections. So now, if you remember, there are some donations which are allowed as deduction under PGBP. So these are the sections which allow donation for deductions. In this, 35 CCA allows deduction for rural development, urban poverty, eradication. 35 CCC allows donation for notified agriculture extension. This is not allowed in the new scheme. Next, 35 CCD allows deduction for expenditure by companies on skill development projects. Again, earlier, these were allowed 150%. Today, everything has come to 100. So it is easy. We don't need to remember the different percentages. Now, section 35, it allows deduction for preliminary expenses. Now, we all know what is preliminary. Expenses incurred before commencement of business. Here, preliminary expenses which are allowed as deduction under 35D has to satisfy some specific conditions and requirements. What are they? First, who are eligible for this deduction? You should be either Indian company or you should be any resident other than a company. So you can be individual, HF, anybody, but you should be resident. First condition. Second, what is preliminary? The expenses is incurred either before commencement of business or even after commencement of business, but in relation to extending the existing business. So, one, you are starting a new business, so expenses before commencing, or your business is already going on, now you are extending the existing business. This is also covered. Next, what are the expenses that are eligible? In preliminary, the expenses that are eligible are expenses incurred on preparation of feasibility report, project report, or conducting market survey or any type of engineering service. Now, please understand, students, whenever you have to start a business, these are the things which you'll always do. What is this feasibility or project report? You make an estimation of how the business would be run, how much profits I am expected to earn, how much period I will be able to recover my capital, etc., etc. In fact, on the basis of these reports, only one, as a promoter, you take a decision whether or not to start business, invest money. Two, you can even raise finance. You can go to banks for loans. So for all this, the first step is preparing the reports. Second is you conduct different types of surveys. This also helps you in identifying first how much sales you can expect, what all are the different markets or what are the expectation of customer and the market. And on that basis, you can plan everything in the business. So these are the preparatory work that is required. So first, preliminary expenses covers the expenses on all this preparatory work. Now there is a condition that in order to get deduction under this section, this preparatory work is either done by you or generally you will hire experts. So whoever you are hiring, that concern
that particular expert should be approved by the CBD. So the firms which are doing these assessment or project work should be approved. Next, all legal expenses, because whenever you start a new business, you have to do many registrations, you have to enter into different contracts and all, for which you require legal services. That is also covered. Next, where the assessee is a company, they incur some specific expenses like drafting of their memorandum of association, article of association, even printing. Next, fees for registering the company. Then expenses relating to issue of shares. Now, what are these expenses? You have to pay underwriting commission, maybe brokerage, then different charges for getting the prospectus, printing, drafted, etc. So all these are the specific expenses incurred by the company. All this is the eligible expenses under this section. If you have spent money on anything else, that will not be allowed as deduction if it is preliminary. Now, let us say total of this comes to 52 crores. Now, I will not give you deduction of entire 52 crores. They say we have kept a limit on maximum amount that you can claim under this section. What is the limit? If you're a company, if you're not a company. If you're not a company, the limit is 5% of cost of project. Cost of project means your long-term assets. See here, the definition is given, like land, building, plant machinery, leasehold property, etc., etc. All these are long-term assets. So make a total of your long-term assets, take 5% of that. Let us say this 5% comes to 55 crores. If you are a company, you have to take higher of 5% of cost of project, 5% of capital employed. How much this 5% comes to? This comes to 45 crores. This comes to 55 crores. So higher of this is 55 crores. Now, whoever you are, you have to decide the limit. Now, your actual expenses are 52 crores. Your limit is 55 crores. Obviously, what will be allowed is lower of these two amounts. So in my example, it will be 52 crores. That is actual expenses. So whatever are your actual expenses, compare it with the limit, and comparing with the limit, obviously limit is the maximum amount. Your deduction will be lower of these two amounts. So in my example, it comes to 52 crores. Now the deduction will be allowed over 5 years. So from the year in which you commence your business, you start taking 1/5 of this amount as your deduction. So 1/5 of 52 crores in year 1, year 2, year 3, year 4, year 5 of your business. Is this fine? This is the deduction for preliminary expenses. Then, if you have given the VRS to your employees, VRS is voluntary retirement scheme. So, I want to reduce my workforce for any reason. Now, if I remove them without any reason, there can be labor problems. I may also have to pay them compensation under Industrial Dispute Act. So instead of getting into all that trouble, what I decide is I enter into an agreement with them whereby I give them the option to leave the job voluntarily. And for that, I'm ready to pay them some compensation. So you would have heard about this VRS compensation salary chapter also. Over there, it is income for the employee. Here it is expense for the businessman. Now, a businessman who is paying this VRS compensation will be allowed the deduction 1/5. Now, important, this deduction is allowed from the year in which it is paid. So the year when you actually pay this, from that year, you can claim deduction over 5 years, amortize it over 5 years, and every year you'll get deduction of 1/5 of this amount. Then comes a section which gives a list of many expenses that can be claimed as deduction. I've made a summary of that. That is section 36 bracket 1. So first 3 clauses. This is 1A, 1B, 1C. These are the 3 different clauses. They give you deduction for insurance premium. What is the difference? First is you have taken the policy on the stock. So if you remember in accounts, you have studied this loss of stock policy. Second, where cattle is required in your business, like you are a dairy product manufacturing company like Amul, and you have your own capital, or for that matter, you are any company which is into dairy products like paneer, cheese, and all, and you have your own cattle, cows, buffaloes, etc. So you take insurance on their life. So the insurance premium that you pay on the life of this capital, that is what is eligible as deduction. Next, when it comes to employees, if you are taking insurance on the life of the employee, there is a problem. Now, there are two possibilities: regular life insurance policy or key man insurance policy. Both are life policies. Now, if you are taking a regular life insurance policy for employee, deduction is not. If you are taking a key man insurance policy on your employee, deduction is allowed. So for life insurance on the life of employee, you have to be clear which type of insurance you are taking. This is allowed under section 37 bracket 1, that is the next section. Now, what is allowed over here is the premium paid on the health of the employee. So health means the medical premium. So where you have taken medical insurance on the health of the employee, you can claim deduction. Here there is one small condition, that this premium should not be paid in cash. Here the requirement is only of cash. Here if you pay by bearer check or cross check, it is allowed, because this is not of 40A3. It is another restriction, that here the only restriction is cash is not. Next deduction is interest, where you have taken any loan. For that loan, whatever interest you are paying, that will be eligible for deduction. Next, these are all employee related deductions. Now, what are they? As an employer, you have to contribute to different funds of the employer. So one is provident fund, another is pension fund, then you have gratuity fund. Where you are contributing to any of these funds, what is important is these funds should be approved. So deduction only to approved funds is allowed. Unapproved funds is not allowed. This we studied even in section 40A9. Now, your contribution to any of these funds which are approved is allowed as deduction. Now, there is a new fund, 80CCD, where whatever you are contributing, which is called as a pension fund, is also allowed. Here, there is a limit given. You can claim maximum deduction up to 14% of salary if you are a government employee. If you are a private sector employee, you can claim maximum deduction up to 10% of salary. Where you have deducted contribution from employee. So one is you are paying contribution from your pocket. One is you are taking deduction from employee by deducting it from their salary and then depositing in provident fund. So where you are taking employees contribution, not employer, employees contribution, this deduction is allowed provided you have deposited that money within the due date as per the relevant act. Relevant act means Provident Fund Act, Pension Fund Act, whatever. So for employees contribution, you get deduction if you are depositing it within due date of their respective acts. Next, bad debts is allowed as deduction. Where animals are used in your business. Interestingly, there is no depreciation on the animal's cost. But in the year in which these animals will die or they will become useless, not useful to the business, in that year, I will give you deduction of the cost at which you have purchased this minus the amount that you have realized on its sale. So many times you sell off the old animals, or after its death, you sell off the carcasses of these animals. So if you realize anything on the sale, that will be deducted from the cost and the difference will be allowed as deduction, but it will be allowed not in the first year of the animal's purchase, but in the last. Next, where you have issued a zero coupon bond, whatever is the implied discount, that discount is amortized over the period of the life of this bond and it is allowed as deduction. Family planning, we have already studied, it is allowed only to companies. Revenue expenses allowed full, capital will be allowed over 5 years. And then if your business includes share transactions, security transactions. So whatever STT you pay, securities transaction tax, or CTT, commodities transaction tax, is allowed as deduction provided this trading is part of PGBP. Why this is specified? Because a person like me who is not into the business of share trading, still I am having some portfolio. Tomorrow when I sell these shares, I will also be paying securities transaction tax, but my income is not covered under PGBP. It goes to capital gain because I am not into the business of trading in shares or securities. So those who are in the business of trading in shares and securities, for them, it will be PGBP head income and they will get deduction of these amounts paid. Same thing is repeated again, commodities transaction. So 36 months cover these common expenses. And then comes your last section, 37, residual. Now in this section, they have not named what expenses will be covered. It is like others, miscellaneous. What they say, those expenses which are not getting covered in the other sections, you can cover it over here, provided you have satisfied the 4 golden rules. Now, generally what will get covered over here is first is the keyman insurance policy premium. Second most important point, if anything is in the nature of an offense, you cannot claim the deduction. Now, this point is specifically relating to pharmaceutical companies because they provide many kickbacks, freebies to medical practitioners so that the medical practitioners may prescribe their medicines. So if they are doing this, they will not get the deduction for any of these freebies or kickbacks because that is an offense as per the IMA provisions. Similarly, where you are incurring expenses on doing CSR, I'm sure in company law you have come across this, that companies have to compulsorily spend some portion of their profits as CSR. Now, when company is spending this as CSR, the question is whether you get deduction under income tax or not. For this, there are 2 points. First, if this CSR expense is covered in any of these sections from 30 to 36, what we already studied, you will get deduction. But if you want to claim it under 37(1), that is under this general section, it is not allowed. So you have to be very clear that whatever CSR you are doing, you should ensure that it should fit somewhere in 30 to 36. Now in 30 to 36, where it will fit, it may fit in any of the donation sections. It may fit in the payment to outside scientific research approved organization. So there, if you are doing scientific research expense, at least you can claim deduction. But if it is not fitting in any of 30 to 36 sections, you cannot claim it under this generic section. Next, what is not allowed under 37 is where you are doing expenses in the nature of advertisement. But where is this advertisement done? It is done with the political parties in any of their rallies, or you are putting your advertisement in the brochures or pamphlets of political parties. Indirectly, you are making payment to political parties for this advertisement. It will not be allowed as deduction. Correct? This is not applicable to us, so keep it aside. Now, another interesting section. This section is applicable only to partnership firms and LLPs. Now, all sections that we have studied till now applies to a partnership firm. So all expenses, 4 golden rules, then all those restrictions and disallowances that we studied, everything applies to partnership firm. However, for partnership firm, there are 2 additional expenses which are only related to partnership firm. One is interest that they are paying to the partners on their capital or loan accounts, and the remuneration, salary, whatever you say, they are paying to the partners. Now, both are partners' income under the PGBP only. This we studied in section 28 itself. Now, we are studying this point from firm's perspective now, that whatever firm is paying to the partner in the form of interest or in the form of remuneration, whether it will be allowed as deduction to the firm, the answer is yes, subject to conditions what are given in this section, that is 40 clause B. What does 40 clause B says? If you want to take deduction of this interest of the remuneration, first ensure that this interest and remuneration payment is covered in your partnership deed. So your partnership deed should allow you, should authorize you to make this payment. If your partnership deed is silent, we will not give you deduction. So you should have a specific term specific clause in your partnership deed saying that the firm will be paying interest, the firm will be paying remuneration to the partners. Second, once it is authorized by the partnership deed, the second thing that you have to ensure is it will be allowed from the date it is authorized. Means what? You started partnership 10 years back, but you are not knowing about this particular point. Your chartered accountant told you that you will not get deduction if you're not showing this amount, this condition in your partnership deed. So you amend your partnership deed from this date. That is from this year, 1st April 25. So you will be allowed deduction for interest and remuneration, but not backdated. You will be allowed it only from the date when this clause is inserted, that is from 1st April. Next, if you are claiming interest, the interest is allowed up to maximum 12% per annum. So your partnership deed may say 20%, no problem. Partnership deed can say anything. We will allow deduction up to 12. But 12 is not final, it is maximum. So if your partnership deed is saying 10, we will allow 10. So 12 is the maximum limit. Up to 12, you can claim deduction. But compare it with partnership deed, whichever is lower is what is allowed. Now comes the remuneration part. For remuneration, there is an additional condition that it should be paid only to working partners. Interest can be paid to both, either a working partner or even to a sleeping partner, because capital will be by both, so you can pay interest to both. Both will be eligible for deduction. But when it comes to remuneration, when it comes to salary, if you are paying remuneration or salary to sleeping partner, I will not give you deduction. I will give you deduction only when this is paid to working partners. Now, when you are paying it to working partners, what is the maximum limit up to which the deduction will be allowed? So for this, they are saying that whatever is your book profit, up to first 6 lakhs of book profit, I will allow you rupees 3 lakhs or 90% of the book profit, whichever is higher. And on the balance, I will allow you 60%. So let us take a few examples. Let us say the book profit is rupees 4,50,000. Sorry, not 4 lakhs, 9,50,000. First possibility. Second possibility, book profit is rupees 5 lakhs. Third possibility, there is a book loss of rupees 2,50,000. Now, in these three cases, book profit 950, book profit 5 lakhs, or book loss 250. How much remuneration you can pay to the partners? First scenario, when your book profit is rupees 950, how much you can pay? Up to first 6 lakhs of book profit, you can pay 90%. So how much 90% will come to? 540. Correct? For the balance, now how much is balance? It is 3.5 lakhs. You can pay 60%. So for the balance, over and above the first 6 lakhs, for the balance, the amount is 60%. So it comes to 210. Correct? So total you can pay 750. Second possibility, your book profit is rupees 5 lakhs. How much you can pay? 5 lakhs into 90% is how much? 450. You can pay 450. Correct? Now what condition they have given is 3 lakhs or 90%, obviously whichever is higher. So wherever 90% is higher, we are taking that. Now, third possibility is you have a book loss of rupees 2.5 lakhs. When it is a book loss, it means the book profit is nil. We will not consider the amount of book loss. It means the profit is nil. So 90% of that will be nil. In this case, you will be allowed the minimum of 3 lakhs. So in this case, the deduction allowed is rupees 3 lakhs. Correct? Have you understood this working? So for remuneration, they have given this particular working, that is up to what amount you can pay remuneration, and that will be allowed as deduction. First is it should be paid only to working partners. And second, up to this limit, we will allow, you can pay more, no problem. Partnership can decide how much it wants to pay. But the total deduction which we will allow is up to this amount which we just calculated. Fine. Section 40 clause BA applies to AOP BOI. For AOP BOI, there is no deduction of interest remuneration. So any interest remuneration which AOP BOI is paying, it is not allowed at all. Beta, you are again asking me a question for which there is no logic. I will put it differently, Anubhav. This happened even in the previous class. I don't remember who asked me a similar question. I put a cross question that you are saying, why 6 lakhs? So I'm asking you, okay, you tell me. If not 6 lakhs, then how much? Tell me. If not 6 lakhs, tell me any amount. 10 lakhs? Okay, 10 lakhs. 5 lakhs? Okay, 5 lakhs. Please understand, beta. When we talk about any amount, any percentage, there may not be any logic of how that amount or percentage has come. Like today, if you ask me, sir, why the first slab is 5%, why the second slab is 20%, there is no logic why 5 and why 20 and why 30. Every lawmaker has a choice to decide what limit, what rate, what percentage they want to keep. This was not 6 lakhs always. If you go back in the law, you will find that this was 3 lakhs. Maybe prior to that, which I also did not study. I've started studying this from the year 2000. So I don't know the law prior to that. So it may be even less. So as inflation is growing, they are increasing the limit. That is the only logic. And it is again purely dependent on the lawmaker, what the lawmaker feels appropriate. Correct? Soumya beta, in third case, I have said that there is a book loss. Now, when there is a loss, it means the book profit is 0. So what is our rule? 90% of it, but it is coming 0. If you see this slab, they have said that for the first 6 lakhs of book profit, minimum 3 lakhs or 90% of book profit. It means you have to pay whichever is higher. So till my 90% was higher, I was paying that. But the moment the 90% is below 3 lakhs, you will have to pay minimum 3 lakhs. Is this fine, beta? Section 41, we have already discussed that 41 covers what? It covers refund, recovery, reimbursement of expenditure of law or losses which are pertaining to past years, for which you have already claimed deduction in the past year and they are recovered now. Now, in this relation, first is 41(1) general rule, this is this rule. Then we have studied this balancing charge just now in case of SLM, that is power units. Then 41(3) we just studied when scientific research, they sell their assets. 41(4) covers recovery of bad debts. So different subsections cover different case scenarios, all follow this simple logic. That these are expenses of past year for which you claim deduction then, now you are repaid back. Now, with this, we cover all sections on incomes and expenses. Now, there are 3 sections for some procedural part. Now, out of these 3 sections, 2 sections are, first is maintenance of books, first section. Second is getting your books audited. And then we have the third part, which is presumptive income. Now, we'll study this from our module, because module has covered this extensively. So 3 things we have to study: maintenance of books, getting the books audited, and the presumptive incomes under PGBP, right? Studied all these sections, all these restrictions. 51 is done. 43B is done. 43CA we studied of taking that value, stamp value, 10%, 110%, Now 44 AB, compulsory audit. But before that, we have something called as presumptive incomes. What is presumptive income? Now, till now, we studied that PGBP income will be computed by taking the figures of incomes and expenses and then applying the PGBP provisions, what will come in PGBP. In some cases, they have given some amounts, they have given some restrictions, they have given some calculations. According to that, you find out your entire PGBP figures. And then when you put it in a proper format of P&L, you get the net PGBP income. This is the simple point. Now, instead of doing so much, making a P&L or making that reconciliation, finding out what incomes will come, what expenses will come, doing the calculation of depreciation and so many, the income tax says no need to do so much if you are a small business. If you are a small business, you can compute your income directly. How is that directly computed? It is 8% of the total receipts or turnover of your business. Simple. No need of depreciation block. No need of preliminary expenses working. No need of checking allowed, disallowed, whether you have satisfied the condition of TDS, whether you have satisfied the condition of payment about 10,000. No need to check anything. If you are a small business, for small business, they have made a simplified method of computing income called as the presumptive income. They are presuming. So they are not going to take the actual figures and they are not going to do actual calculation. Now, what is the logic? The logic is you are a small businessman. You may not be in a capacity to hire a chartered accountant who will be having this complete knowledge and who will be doing your working. So if it is not possible for you to hire a consultant, hire a professional, then better is we give you a simple approach. What is the simple approach? Simply take 8% of your total sales. Now, any businessman will know their sales. Take 8% of it. If your method is cash, then take 8% of your gross receipts. That's it. 8% is your PGBP income. Full stop. In this, now they have given a relaxation where you are receiving payment by account, paycheck, or the approved electronic medium. Now, the government wants to promote this. They want more and more payments to be or the business to be done through proper banking channel. So they are saying, out of your total turnover, whatever turnover is through banking channel, we will not take 8%, we will take only 6%. So let us say your total turnover is 1.5 CR. So your total turnover is 1.5 CR, out of which 90 lakhs is by banking channel, 60 lakhs is in cash. So you are a Kirana shop. Simple example. The best example of this section is Kirana shop. So you go to a Kirana shop near your house, you find that many people are paying in cash. And nowadays, because of that QR code and so many things, many are paying online or through QR code or credit card, debit card. Now, in this particular case, the turnover of that Kirana vendor is 1.5 CR for the year. He comes to you for computation and filing of returns. You will apply this simple section. Out of 1.5 CR, 90 lakhs is through proper banking channel and 60 lakhs is in cash. So on 90 lakhs, multiply 6%. So 90 lakhs into 6%. Plus, on the balance 60 lakhs, which is in cash, multiplied by 8%. This is the final PGBP income of that Kirana person, which you calculate in 2 minutes. No need of applying any section which we studied in past 5 lectures. We cracked our brains. We took the pains of reading it again and again, revising it again and again, going into deeper point. No need of doing anything. Simply take the turnover, take the gross receipt, apply this formula. Perfect. Now, for whom this particular simple method or approach is given? It is given for small businesses who are in the unorganized sector. Now, who are they? They say that this person firstly should be either an individual or HUF or a partnership firm. but they are not allowing LLP here. Generally, everywhere, wherever there is partnership, they are also allowing LLP in the same category. Here they are not. So you may be individual, you may be HF, you may be a partnership firm. First condition. Second condition, you should not claim any special benefit under Section 10AA or Chapter 6A Heading C. These are special benefits. Now, why they are putting this condition, don't claim these special benefits? Because whoever has to claim these special benefits has to get the books compulsorily audited by a chartered accountant. Now, where you can get your books audited by a chartered accountant, why you want this benefit? We are giving this benefit for small businesses who cannot hire a chartered accountant or cannot get the books audited and do the detailed working. So for them, we are giving a simplified option. So where you are already claiming these benefits, it means you can hire a CA who is coming and doing your audit. So better is you follow the normal provisions, what we studied till now. We will not give you this benefit. And most important, the turnover of your business is not exceeding 2 crores. So this is what we mean by small business. Now, importantly, again, in order to promote cashless economy or everything through banking channel, they have given one more condition, that where in the previous year, your total turnover, gross receipts, 95% or more is through banking channel. That is, less than 5% or up to 5% is only in cash. We will increase this limit to 3 crores. So up to 3 crores, you will be covered here. Now you will find today that practically majority all these businesses, kirana shop, barber shop, etc., majority our payment is made through online because people have got into the habit of scanning the QR code and making payment. So it is possible that 99 or even 100% receipts in all these small businesses which you see around you, some ice cream parlor or something, all these are those small businesses which fit over here. These are the practical cases. Any small gift shop, all will fall here. They can take this benefit up to 3 crores. So for them, up to 3 crores turnover, they will be falling in this particular section. Now, this section does not cover certain specific businesses. One, they does not cover transporters. Why? See, that is exception is given over here. They are not covering transporters because for transporter, we have another section 44A. Similarly, they are not covering professionals for whom we have another section 44AA. Not AA, it is I think a typo error. It is 44ADA. So those who are covered in some other sections, for them obviously this section will not apply. Next, those who are getting income by way of brokerage commission, that is they are into agency business. So where they are not the actual traders. For them, the sales is not their sales. They are only commission agents. So their income is only the commission. They are also not covered in this section. Correct? Now, the second similar section is for us, professionals. So where you are into profession. Which profession? Profession which is specified in 44AA. Now, what are these professions specified in 44AA? Lawyers, doctors, engineers, architects, chartered accountants, consultants, interior designers, and other professionals which covers company secretary, etc. For them, there is again an estimated or presumptive section. This is applicable provided their turnover or receipts do not exceed 50 lakhs. Now for them, how much is the estimated profit? For them, the PGBP income is 50% of their gross receipts. So 50 lakhs is the limit. Up to 50 lakhs, if your turnover is there, you can fit in this section. If your turnover is above 50 lakhs, you are out of this. You have to go to the regular provisions of add, less, allowed, disallowed, and doing all the workings. Again, for them, same. If their turnover, 95% of that is in banking, that is not by way of cash, or in other words, cash is only up to 5% or below 5%, the turnover limit is now raised to 75 lakhs. So for them, for such professionals up to 75 lakhs, they can take the benefit of this presumptive income section. And then the third business is where you are in the business of goods transport. That is, you are in the business of flying, hiring, leasing goods carriage. These are the technical words. In simple words, you see on the roads, there are trucks, there are small vehicles, five-wheelers, the chota hati, the tempos. All these people fall in 44A. What is the condition? Who will fall in 44A? Now, in above two sections, they have given turnover limits. Here, they have given the criteria that a person who is not having more than 10 vehicles. Now, here they are using the word goods carriage. Goods carriage means the trucks or these tempos that they are using for transportation. So, if you are not having more than 10 trucks, it means you are a small business. Now, we are talking about those persons who are having only one truck, one tempo. They are definitely falling here. But even if someone is a transport agency or a transport company having more vehicles where they have hired drivers, they will also be falling here. Condition is they should have not more than 10 trucks. That is what is covered in this section. Now, once they are satisfying this condition, what is the criteria? They have classified them into two categories for the purpose of computing the estimated income. One, whether their trucks are big trucks, that is where vehicles are heavy vehicles, or they are light vehicles, that is other than heavy vehicles. If their vehicles are heavy vehicles, the estimated income is 1,000 per ton of the gross vehicle weight. Now, what are these terms? Every vehicle at the time of passing with RTO, especially all these transport vehicles, on the registration certificate, they mention this gross vehicle weight. So where the gross vehicle weight is, now first we have to also define what is a heavy vehicle. So for heavy vehicle, I'll show you. So they have not covered. A heavy vehicle is one whose unladen weight is exceeding 12,000 kgs. That is a heavy vehicle. So let us say my truck unladen weight is 15 tons. That is 15,000 kgs is the unladen weight as per the RTO certificate. So I become a heavy vehicle because my vehicle's unladen weight is about 12,000. Now in such a case, how do you compute the income? The estimated income is computed as rupees 1,000 per ton of the gross vehicle weight. Now I said my vehicle weight is 15,000 kgs, that is 15 tons is my gross vehicle weight. So per ton you have to take 1,000. So what is my estimated income? My estimated income is 1,000 into 15, that is 15,000, and it is per month. Now interestingly, we are computing estimated income. So they will not check actually how much transportation I have done. Because if they have to do that, then it becomes a regular method. They are going by the estimated method. So they are not checking actually how much transportation I have done. They are simply saying they will check my weight of my vehicle as per the RTO certificate, the unladen weight, and let us say minus 15 tons. So 15 into 1,000, which is the per ton estimated income. So my per month income is 1,515,000. I have the vehicle for the whole year, so multiply it by 12 months. So 15,000 into 12 months is the estimated income of that one vehicle. Similarly, whatever number of vehicles I will have, you will compute this estimated income in this fashion and add up all this in. Now, this is for big vehicles, or in their language, heavy goods vehicle, where the weight is exceeding 12,000 kgs or 12 tons. Now, you may also have smaller vehicles like the tempos, the chota hatis. For these vehicles, the estimated income is rupees 7,500 per month. So here it is not per ton, it is flat 7,500 per month. Now, they are saying that you are even allowed to show an income which is a higher income than this. So if you want, you can always show a higher income. See, these amounts which we have just studied are the minimum income which you have to show if you are into these businesses. Any of such persons have the option of showing even a higher income. You may claim that I am earning more income. Fine, we will accept it. Anyways, why we will not accept? We are getting more tax. So you can always show an income which is higher than this. Similarly, a person who is engaged in composite business. What is composite? Where I am doing manufacturing also and agriculture, that is growing also. Example, like here you can see coffee, tea. So a company like Tata Tea, a company like Red Label Tea, a company like Brew or Nescafe, they are also having their plantations where they are growing these plants, the tea plants, the coffee plants, like you have even rubber over here. So I'm having the rubber trees. So I have my own agriculture, I have my own forest, I have my own farming where I'm growing also. And those plants, those leaves, those seeds or fruits, I take to my factory where from these plants or seeds or fruits, I'm also manufacturing the tea coffee or I'm extracting that rubber. Now, in this particular case, what we have to do is we have to break up the net profit because in my business, my net profit covers the agriculture part also and the manufacturing part also. Because I'm growing the tea leaves, I'm growing the coffee beans, and I'm also manufacturing it into tea powder, coffee powder, and selling it. So the net profit of my business covers both. Now, when it covers both, I cannot or I should not pay tax on the agriculture portion because that is exempt. But how will I break up? So they are given some estimated percentage. So for rubber business, where you are growing as well as manufacturing rubber, 35% is only the taxable part because that is your manufacturing part. Remaining 65 is exempt because it is assumed to be agricultural. Similarly, for coffee, they have made two categories where you are only growing and curing and where you are growing, curing, roasting, grounding. So here there is more manufacturing activity. So here it is 40% manufacturing, 60% agriculture. Less manufacturing activity, so 25% manufacturing, 75% agriculture. And for tea, it is 40-60. Correct? So this is the estimated incomes given for different businesses. Now coming to the last part, that is the mandatory maintenance of accounts and getting the accounts audited. Now what they are saying, for whom audit is compulsory. Now here they have divided you into the category of person carrying a business and person carrying a profession. Now, I'll first come to profession because it is simple, it is small. If you are in a profession, for you, where your gross receipts exceed 50 lakhs. Now, if you remember, 50 lakhs was also your condition for presumptive income. So where you are crossing this 50 lakhs, you will be liable to get your books compulsorily audited. Point number one. Two, where you are not crossing 50 lakhs, then you are fitting in this presumptive income section. Where you are fitting in this presumptive income section, that is, you are not crossing 50 lakhs, over there you are supposed to take net profit of 50% of your receipts. Now, where you are showing that your income is less than this 50%, so you are covered in that presumptive. See, you can show higher income, you don't have a problem. But where you are showing that your income is less than this presumptive income, so you are showing your profit as less than 50%, and also your total income is below the exemption limit. Sorry, your total income is above the exemption limit. In such a case, also you have to get your books audited. So where first your turnover crosses 50 lakhs, you have to get your books audited. Second, where your turnover does not cross 50 lakhs or where it is through banking channel 75 lakhs, that is you are in the presumptive category. And over there, you are supposed to show presumptive income of 50%. You want to show lower income. Where you want to show lower income and you are covered in the taxable bracket, that is your total income is exceeding the taxable limit. In that particular case, we will ask you to get the books audited because you want to take the benefit of presumptive, but you want to show lesser income, then you'll have to get the books audited. But this is just the last part. Please allow me to complete. I know it is too much, but unfortunately, we have some restrictions of lectures. So kindly appreciate that this is the last part for today. Anyways, this is the end of this chapter also. And obviously, you can always revise, you can rewind and go through the topic again. So don't worry, be patient. Next is where you are engaged in business. So for businesses, what is the condition for getting their books audited? So here, firstly, where your turnover exceeds 1 crore, where your turnover exceeds 1 crore and you are into business, you have to get your books compulsorily audited. However, in this, there are some exceptions. First exception is where 95% of your business is through banking channel. And what does 95% means? The receipts also and the payments also. 95% are through banking channel. That is, through cash, it is hardly 5% or even less. Then instead of 1 crore, the limit for tax audit is 10 crores. So where your majority business is through banking, the limit of audit is raised to 10 crores. You have to get your books audited only after you cross 10 crores. Where less than 95% is in banking channel, then the limit for getting your books audited is after 1 crore turn. Now, in this, if you are into the transport business, that is, you are covered in 44AE, where you should have shown the presumptive income of this 1,000 per ton for big vehicles and 7,500 for the small vehicles. Again, you have to get your books compulsorily audited if you want to show a lower income. So it is simple. We studied the presumptive income. In presumptive income, they have told you that this much is presumptive profit. Wherever you are showing higher, we are okay. Wherever you are showing lower, get your books audited to prove that it is lower. That is a simple logic. So here you will find a transport business. Again, you will find for that 44AD business. For 44AD business, you are supposed to show that 8% and 6%. If you are showing lesser, get your books audited. So this is the criterion. Fine, students. So with this, we have completed entire PGBP. All sections completed. Everything, as you can see here, all sections that are there, we have completed each and every section. In the first 3 sessions, I repeatedly repeated all the sections of incomes and deductions and restrictions, which I am sure now would have been permanently affixed. Still, remember one thing, since we are continuously doing it, you are now comfortable with this topic. But at the same time, if you lose the track of this topic, after maybe 1.5 months, the same thing may become very heavy. So one piece of genuine advice, please keep studying, revising. Don't take a break. Break means not daily break. Don't leave this chapter. You have to ensure this chapter is repeating every week, maybe in every 10 days, not beyond that. And what you have to do is you have to simply read this, let us recapitulate our minds. Fine. So thank you very, very much, students. Thank you for all the patience and study well. Be in touch with your subjects. Thank you. Thank you very, very much. Good night to all of you all. Yes, thank you all. Thank you. Yes, Ashok. Session over. Good night, Ashok.